A very special guest now joins me, someone who needs no introduction whatsoever, Chris Woods of CLSA. Mr. Woods, what a delight to have you back on ET Now. Thank you for joining us. Mr. Woods, we are staring at what could be called as a rather extraordinary time. Locally and globally, the Control-Alt-Delete button, which is the big reset, has started. What do you make of the current environment?
Well, no, I've arrived clearly on Sunday, where the big story is the demonetisation move by Prime Minister Modi, which is clearly both dramatic and extremely bold on the part of any politician. This move got lost on a global basis got lost in the noise generated by the equally remarkable development last week, which is clearly the election of Donald Trump.
Before I get into India-specific factors with you, Mr. Woods, let's talk about the global setup. We have seen a big crash in the bond market, and nearly $1 trillion of wealth has got eroded in the bond market. The dollar index is now nearing 100, and emerging market currencies are falling apart. Do you think this is only Trump adjustment?
No, I will have to tell you, my last quarterly, my view was that Trump victory would trigger what I call a bond riot. And the reason for that is that so many investors are positioned for lower for longer in terms of the outlook on interest rates. Donald Trump's policies are aggressively pro-growth. There was very little discussion on his economic policies during the course of the presidential election campaign, because the news flow was obviously dominated by more colorful aspects in economic policy. But the fact is his Trump policies are aggressively pro-growth. He's calling for aggressive tax cuts. He's calling for big increases in spending, most particularly infrastructure spending. He's also looking to offer a tax corporate amnesty to corporate America to try to seek to incentivize corporate America to return the estimated $2.5 trillion of corporate cash sitting offshore, because corporate America doesn't want to pay one of the highest corporate tax rates in the world. So what's happened, he's got elected to the surprise of the vast majority of people. This has caused a sudden focus on his policies and led to expectation that under Trump, growth could pick up, a velocity of money in circulation could pick up, and this has set off this bond market correction, which can feed on itself for the moment, because markets are still traveling, not arriving. Because of the US system, Donald Trump doesn't become president for several weeks, and so the market is vulnerable to selling off further in anticipation of his policies. And we are now, there's a key technical level on the US 10-year bond. If we break 2.25 on the 10-year Treasury, I think we can move significantly higher. And that is triggering in itself a sell-off in emerging market debt. One of the best trades this year has been emerging market debt. People have made a lot of money in countries like Brazil, Russia, Indonesia buying the debt. The currencies have appreciated. Donald Trump got elected in the middle of November. Fund managers measure return by calendar years. So what they're doing is they're rushing for the exits before all their profits disappear.
Mr. Wood, for nearly a decade now, we have seen a regime where central bankers have printed money and interest rates have remained artificially lower. So given the policy what Mr. Trump is likely to follow, do you think there could be a big departure in global inflation?
Well, there's definitely a potential. I don't want to make a definitive forecast because there's too many unknowns in terms of who's going to be Treasury Secretary, etc. But there's clearly a potential that we have reached an inflection point in the US in this post-2009 monetary policy. In my view, the zero rates and the QE have had the opposite effect of what's intended. They have been deflationary, not inflationary. And in my view, if Donald Trump comes in and implements these aggressive infrastructure policies, there's a significant potential for velocity to pick up. That potentially lifts inflation in America. But the other, obviously unknown, is what's going to be the attitude of the Fed. And what's not clear right now is what's going to be President Trump's attitude towards the Fed. But there is clearly a potential for an inflection point. The surprise to me has been that the dollar has strengthened so much. If you had asked me before the election last week what would happen to the dollar if Donald Trump was elected, I would have said the dollar would have weakened because of concerns of huge fiscal deficits, etc. But clearly that's not been the way the dollar has reacted so far, and that's been another negative for emerging markets. But the other reason, of course, why markets have moved so much is that the Republicans control the Congress. Therefore, people believe there's a much better chance that Donald Trump will be able to do what to be able to implement his policies.
But Mr. Woods, at a time when US cost of capital is likely to move up, ECB and BOJ, they are likely to follow a loose monetary policy. Japan is committed to keep interest rates lower or under check. What kind of cross currents do you think will hit financial markets, because there could be a huge divergence within central banking policy?
Well, yeah, no. If the Federal Reserve has really left behind the days of unconventional monetary policy, which is a big if, but if that's the case, then there will be a dramatic divergence between the US and Japan in the Eurozone. In the Eurozone, we still have 40 basis points negative rates, aggressive QE. In Japan, we have an even more remarkable development. The Bank of Japan has recently committed to pegging the price of the 10-year JGB yield at zero. That's why I've been telling investors over the past week that the best investment on a Donald Trump election is long Japanese equities, short yen, because if the BOJ is going to try and hold the 10-year JGB yield at zero, that means the Bank of Japan is committed to unlimited purchases of JGBs, unlimited balance sheet expansion, which should be very yen bearish. So long as they're trying to hold that level in the context which US Treasuries are selling off, that's going to feed yen weakness, which is going to feed Japanese equity rally. So actually, my favorite trade on this Trump victory is not selling treasuries, it's buying Japanese equities and shorting the yen.
Where do you think emerging markets will now fit in? Because on paper, we can prove that strength in dollar is bad news for emerging markets and especially ETF flows. So do you think the emerging market adjustment is here to stay and emerging markets could underperform for a long time?
Well, no, I think that's where it's clearly emerging markets are now having a reset because of the pressure, the dollar rally and the emerging market debt sell-off. But I think it's premature to assume that the emerging market outperformance is done. A lot of it's going to hinge on how the dollar behaves, and I still think it's premature to assume that this dollar strength is going to continue. There's too many uncertainties on the policy front. The other issue is that the China story has stabilized. What would definitely unnerve investors towards emerging markets if we had renewed evidence of capital outflows accelerating in China, renewed pressure on the currency. But that situation has stabilized in the first 6 months of this year. The fundamental reality is that emerging markets have better growth dynamics and they have better fundamental policy regimes, because the emerging markets never had this, they've never gone into this unconventional monetary policy. Yield curves have remained orthodox, monetary policy has remained orthodox. So from that point of view, I think the emerging market debt story still has fundamental merits. What we're seeing right now is just a sell-off precipitated by the fact that people have a lot of profits to take. So this is a profit-taking correction, not a collapse.
Mr. Woods, you've always liked India. In your model portfolio, you have a big overweight on India. Any reason for you to revisit that call? Because your call is also centered around autos, cements and HFC, which is home financing companies.
Yeah, no, clearly. So my Indian portfolio in the first my Asian portfolio in the first 3 quarters of this year by some miracle managed to outperform the benchmark, even though it was heavily in India, which underperformed year to date in Asia. And the reason it outperformed because it was in areas like auto, cement, housing finance companies, which have been doing well. So the problem for me in the short term is that this demonetization move, which I view as a fundamental long-term positive, is going to cause undoubtedly a slowdown in those sectors which I have been concentrated, most particularly housing, cement, autos. So that is a short-term negative, but do I therefore sell all my stocks in this area because of this short-term slowdown? I'm basically in the process of evaluating that this week. I only got to India Sunday, but the fact is my instincts are simply to hold on because I'm saying this is a fundamental positive development. The market has already discounted some of the slowdown. The real estate stocks, for instance, were down. The real estate index, I believe, was down 10% on the announcement of the demonetization move last week. And I'm hoping that the slowdown in the economy caused by this move will be 3 to 6 months, not longer. But in the specific case of the real estate sector, it's probably going to be longer because that's the sector most hit. And I believe, because cash is clearly heavily used in that sector, most particularly in the smaller cities.
Mr. Woods, your India team recently has changed their model portfolio. They have knocked off HFC companies like HDFC out, and they've introduced Sun Pharma. So do you think for next 3 to 6 months, one is better off revisiting Indian defensive stocks?
Well, in the very short term, that makes sense because pharma is a much more defensive sector based on this demonetization move than areas like housing, finance, or cement. So I understand why they've done that, but my portfolio, I don't trade it aggressively. It's about 25 stocks in Asia. It's not my style to make short-term tactical moves. So fundamentally, if I believe this is a positive long-term reform, and I believe the slowdown should be, but most of the slowdown should be confined to a 3, perhaps 6-month period, it doesn't make much sense to do huge rotation.
Mr. Woods,
the key question on this demonetization. So the key question now on this demonetization move is quite clear that it's a long-term positive, but involves short-term pain. The key question is that it's now the technical implementation works, i.e., they recalibrate all the ATM machines in a reasonably short period of time. That's the issue now. The issue is now operational.
Mr. Woods, you've always raised concerns about government's inability to take care of PSU banks and their balance sheet. But now that black money will move back into the banks and banks will have a strong liquidity and CASA, do you think one should not worry about the capitalization of Indian PSU banks?
No, I think that's still a big issue. You're absolutely correct. I have been going on about that in recent past, and I believe that's still a big issue. In my view, there's been a huge amount of reform implemented by the Modi government since it came into power, and clearly it's now halfway through its first term. The single most dramatic reform is what was announced last week. But I would say if there's one area of disappointment regarding this government, it's the relatively slow progress towards addressing the banking issue. There has been a lot of progress in terms of forcing banks to own up to bad loans, but there's been a lack of progress in terms of recapitalization. That lack of progress in dealing with the stressed assets in the Indian banking system is definitely delaying the investment recovery, of which there is still no sign. So I think all that remains in place, that issue. However, there's also no doubt that the positive aspect of this demonetization is the following. It should lead to a pickup in deposit growth in the banking sector. That should give banks more room to pass on lower interest rates to borrowers. And we believe that the currency and the bond market will be positively impacted by the demonetization, whereas the impact on the equity market is a short-term negative. And I think we are now forecasting 3 rate cuts next year in India, which is significant and probably not consensus, and that's precisely because of the impact of demonetization. The other point is tax revenues as a percentage of GDP should lift structurally in India, and that should be a long-term positive in terms of bringing the fiscal deficit under control. What I would personally like to see, but it probably won't happen, what I would personally like to see is that the RBI may make money on this demonetization move if the estimates are correct that between 10 to 20% of the cash in the system never returns. So what I would recommend would be if that's really the case, that this money should be used to recapitalize state-owned banks once the government and the authorities are reasonably convinced that the state-owned banks have owned up to all their problems.
For last couple of years, India has been more like a consumption bet on the demographics, buy paint companies, buy consumer companies, buy autos, then you pretty much have got a winner. But now that there is a reset in the economy, do you think the leadership in the market will change? Consumers will take a backseat, investment and government related sectors and themes will come back as leadership sectors?
Yeah, but the problem is we don't believe investment's about to pick up. I mean, right now there's no evidence of investment picking up. The one area where investment activity seems to be happening is government finance infrastructure spending, which is growing strongly this fiscal year, and we expect to continue to grow strongly next fiscal year. But in terms of classic capex, we don't see any evidence of a pickup, and I think part of that reason is capacity utilization remains low, but the other part of the reason is the overhang of NPAs. So if the capex is not going to pick up, the other potential area of private sector investment that could pick up is the whole real estate construction sector. Now, before the demonetization move, I was of the opinion, I believe my colleagues here in India were of the opinion that that was showing signs of bottoming, so there's a better chance that investment activity could pick up in the real estate sector than in the capex area. But the demonetization move has just delayed that pickup.
Couple of closing questions from you, Mr. Woods. Now, Indian markets have always traded at a premium to other emerging markets, largely because of some of the banks and some of the companies we have. So currently, when cost of capital in the world could go up because of appreciation in bond yields, do you think that could hit a market like India, which is trading at a big P multiple? Because if cost of capital goes up, P multiples will get compressed?
Yeah, but actually, although India remains quite expensive, actually on a relative basis, because other markets have rallied, India's relative overvaluation relative to other Asian markets and emerging markets is less than what it normally is. First point. Second point, I'm hoping that we don't get a big pickup in bond yields in India, precisely because I believe the demonetization move should support stability in bond yields, if not lower bond yields. So I'm hoping that negative impact doesn't kick in. The other positive of things going for the Indian market since the arrival of Mr. Modi as Prime Minister is that we've had almost every month domestic mutual fund inflows into equity. So that's definitely a support.
Mr. Woods, what about the other large sectors which are outward in nature, IT, pharma? There is a challenge for Indian IT sector because Indian IT companies are struggling with the old business model. For pharma, there is a price erosion. Now, Nifty or broadly top 50 companies, they get 45% of the earnings which are global in nature. So do you think on an aggregate level, things may not look up because IT and pharma will push the aggregate picture down?
Yeah, maybe, but I've never had those sectors in my portfolio. So at least I've only had them marginally in my portfolio. So I'm primarily focused on the domestic demand theme.
What is
the way I look at it, Well, the way I look at it is nominal credit growth's been running in line with nominal. So credit growth has been running in line with nominal GDP growth for several years in India. So we've had an extended deleveraging cycle. So the longer this goes on, the bigger and more pronounced is going to be the investment upswing when it arrives.
You've been very vocal about your thoughts on gold. Every time we've interacted on different forums, when I scan through your note, do you think gold could actually continue to surprise us? Because frankly, if I look at the gold comeback in 2016, it's been nothing short of extraordinary. Gold prices are up more than 17-18%.
Yeah, but gold was doing extremely well, but clearly the issue for gold in US dollar terms in the next 6 months is going to be determined very much by if we've reached an inflection point in economic policy in the US and how the currency markets react to that. So that is something I think we're in a wait and see mode. If you're based in Europe or Japan, though, if you're euro-based or yen-based, gold looks still extremely attractive because they've still got these aggressively high beta unorthodox monetary policies.
Closing comments from you. I know I've extended my appointment with you. So my final question would be that you've always been an India bull, and we've always appreciated your vocal stand about why you like India. Any reason for me to believe that based on the current demonetization drive, Chris Woods is rethinking about his India exposure?
Oh no, I think this demonetization move is a reason to become more bullish on India. This is an extraordinarily bold step. As I say, normally these kind of actions are only taken in the midst of macroeconomic crises, and if anybody was in doubt that Mr. Modi was trying to reform the Indian economy, those doubts should have been shed with this remarkable move. But it is an extraordinarily bold move politically because conventional politicians would simply not take this kind of risk.
All right, Mr. Woods, it's always a pleasure and really appreciate your time. Thank you for joining us.
Okay, thank you very much.
That was Chris Woods of CLSA. He's been bullish on India, and he believes that the demonetization drive will make him more bullish. Is he looking at increasing his India weightage? Too early to assess that. But in terms of mood change, his current preferred themes are still autos, private banks, and a little bit of real estate.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.